Oh, hello once again. This is SeeWing Yee from the Yee Real Estate Network, and my special guest here is Mr. Richard.advani from Supreme Lending, who does financing for investors and primary buyers in all 50 states. So welcome, Richard. Thank you for your time and effort to do this weekly podcast with me. By the way, my company is the Yee Real Estate Network. We are a real estate investment club. Been doing it since 2004, and Richard has been running his very good team of mortgage loan professionals for a number of years. He has done many investment loans, not only for our investment club members of investors, but he also has some very great connection with other investment clubs throughout the country. And he's getting so much business, and he's doing a great job. He's not only a loan advisor, agent, he's a loan advisor. He understands the investment goals and objectives of each investor. And so he and I, we work as a team very well for our investors. It's all about at the end of the day, is to help our investors achieve their financial freedom goal and walk them through the process and so forth. So without further ado, let's go. Today's short topic, we're going to talk about over the years, Richard and I have helped many investors to create their real estate portfolios out of state. Most of our investors are in California, but some of my investors are in other part of the country. But when we help people design the portfolio over the years, we help them to buy in different markets. So our experience is such that there are really, when it comes down to it, there are only two regions in the US where we help our investors buy, and that is in the Midwest of the US and then South and Southeast of the US. And let me tell you why. Because, excuse me. Because the Midwest real estate investment properties, turnkey properties, that is, are, you have a higher level of cash flow, and the purchase price is lower, and the down payment, the amount of money you come up to buy each property is a lot less. So we're not saying it's good or bad to buy, in whatever areas. We just, each investor is different based on their goals and objectives. And so when we make recommendations, we have to do what's right for the investor, but at the same time, we educate them. So we can talk about, again, low purchase price, older properties in the Midwest, such as, Buffalo, New York, Indianapolis, Indiana, St. Louis, Missouri, Memphis, Tennessee, Cleveland, Ohio, Detroit, Michigan. So this type of single-family homes up until 4 unit, again, provide very high cash flow, very high cap rates, very high rent-to-value ratio, and cash-on-cash return. All the numerical metrics that we talked about. And then the other concept, the other things that investors do over the years, they also buy into South and Southeast, much more expensive properties with a higher appreciation potential, newer properties, and a little bit less cash flow, but more potential for equity growth and what have you. And of course, the down payment is a lot higher, assuming one will do financing. So, Richard, before I'll have you discuss this is just a sample property. Just ignore the specific location, because, when it comes down to it, this is cookie cutter portfolio. So this property, happened to be a duplex in Midwest portfolio, like a turnkey, all rehab, a tenant in place more often than not. These duplex cost $76,500. So with 25% down payment, which is only total out of pocket. Think about this, investor, $23,000 total out of pocket at 25% down payment plus closing costs, you're able to buy this property, this duplex, turnkey, rent ready, a tenant in place for $76,000, and the rent is $1,300 on both units combined, so $650 per unit. So so you minus all the monthly costs, as you can see down here. I'll be real quick, Richard, so you can get some input on this. You know, the numeric metrics is, you know, very, the benchmark is very high, you know, rate to value ratio, 1.7%, capitalization rate, 11.8%. Look, some of you are thinking, oh, am I talking over your head? Some of you are newbie investors. I get that, but again, if you sign up for my membership on my website, you will get free weekly newsletters. You'll learn about these numerical metrics. We have other videos. We have hundreds of videos for free for our members to get educated on. So anyway, so at the end of the day, the mortgage, again, this 30-year mortgage, 3.5%, probably higher than that. So 25% down payment, you minus all the debt obligations. So the net monthly cash flow in this case is $493. So which is pretty nice. You know, the annual cash flow is over $6,000. You know, maybe a couple percentage of appreciation, and before you know it, at the end of the first year, you know, you may accumulate $11,000 of total equity and total annual net cash flow equal to a very high rate of return. So again, at the end of the day, only $23,000 out of pocket, you're able to buy this duplex for $76,000, achieving almost $500 of net monthly cash flow. So, so I'm giving you some numeric analysis. So now, so Richard.advani, as a loan agent, you have done many loans with investors buying in the Midwest. So what are some, from a non-numerical perspective, Richard, you also have some properties in the Midwest as well, so you have firsthand experience. What are your thoughts on the qualitative aspects of buying, the pros and cons of buying into Midwest property in the one that I just described?
Absolutely, and I know this is just an example, but the first property I ever bought 14 years ago was actually a 2-unit in Buffalo, New York. So very close to this example that you listed. And I mean, in my mind, there are pros and cons, but more importantly, I think knowing what you're buying is very important, and having those expectations, right? A property like this, which I own many of, are great properties. They generate a very, very high cash flow, as you can see. I mean, triple, quadruple of what you will find in almost any other market. But with that generally will come, obviously, a little more work, you know. And look, I have some clients that will only buy new construction homes in A+ areas that make 4% cap rates or even less, because they're looking more for asset diversification and looking for growth and aren't necessarily interested in the income. And then I have other clients that have 40 loans in their portfolio, 40 properties that are very similar to this. They're high cash flow, high return. But with that, once again, inevitably comes, you know, they're not going to be quite as passive as, say, buying a new construction home with a lower cap rate. But they still make solid investments, and especially on a multi-unit. You know, if you have one unit vacant, you always have that second unit. And what's really amazing on this property is, you know, one of the units rented out will really cover the overhead of the property, more than cover it. And then you throw the second unit in, and obviously that's gravy on top. I know, of course, you set aside some vacancy reserve, I see, on this. And, you know, it's a good idea, obviously, to have a little bit set aside for repairs on these properties that are a little older. But all in all, even if you have a long-term portfolio, buying these properties, you know, enjoying that cash flow, but then also making capital improvements to the property, that way they become more and more passive. And that way, you know, they perform well over the long term is definitely something you want to do, especially those first 2 or 3 years. You know, reinvesting, not a big portion, but some of those returns into making the property a little nicer and performing better in the long term, of course. But they're great properties. And getting back to what I said before is knowing what you buy, right? There's no such thing as real estate that's not a good, or real estate that doesn't make a good investment if you're buying the right property and if your expectations are realistic. I think where people potentially get surprised is, they're looking for or expecting a brand new construction experience with a tenant in that type of area when they're buying, a high cash flow property. And it's going to be a little bit of a different experience. It's going to be a little bit more work, but the returns typically are 3 to 4-fold of what you'll get in those areas that offer less return. And obviously the price points are 3 to 4 times higher on those. So these are great properties, especially for a new investor who has limited capital that they can deploy rather, and also for experienced investors who are just looking for more cash flow in their portfolio, or someone who's 5 to 10 years from retirement, buying a bunch of homes in North Carolina or Texas that make you $50 a month probably is not going to be the best path forward for you, right? Properties like this that generate tangible money, which is what you need right now or are going to need to replace that retirement income, is very important. So, it's, as you guys can tell kind of from the theme of things, different properties for different folks. Depending on what your goals are, SeeWing will, of course, direct you to a market that's going to kind of fit those goals. But
absolutely. Yeah, I agree, Richard. Very well said. There's nothing more that I need to say other than when I work with some investors, that already have some of these Midwest properties. Sometimes they can't handle, the little bit of stress, dealing with the maintenance and a little bit of vacancy here and there. And but it's all about the mindset, about the emotions of a particular investor. Can they take it? Can they, are they okay with the additional work that's necessary with the Midwest properties? But it's not for everybody. So each investor is different, financially, goals, emotionally, personality, whatever. They all plays a part. So the other end of the spectrum we're gonna talk about is the other category of properties that investors buy out of state, turnkey, or the in the South and Southeast, typically in Texas, in Florida, and in North Carolina, to name a few areas that where you buy a new construction or a recent resale homes where the prices are much higher than the older cash flow portfolios in the Midwest. But it's nice asset allocation, nice diversification of the markets. But furthermore, if the investors have ample financial resources, down payment, what have you, and they want like I said, a good quality property with A class or class neighborhood, B plus neighborhood. So in this example, let's go with the example. This property happened to be in Raleigh, North Carolina, and the home of the Research Triangle Park, very high tech. So the property typically, this is a resale, few years new, and 1,800 square foot, 399,000. Yeah, single family home already $399,000. So this kind of market are appreciating very well, especially recently. And of course, you need to put 20 to 25% down payment. In this case, as you can see right here, is almost 100 grand, right? 100 grand out of pocket to buy a $399,000 property. So you have to look into that. And the rent, as long as the rent, it makes sense, the numbers make sense, $2,300, you can have a high-class tenant that willing to rent this property for $2,300 per month, then the numbers really work, right? Then you minus the monthly debt obligations, as you can see right here, taxes, insurance, property management fee, a little bit of maintenance here and there. So the numerical returns are not as good as the Midwest property. The cap rate is a little bit less than 5%. The benchmark, to achieve cash flow, in my opinion, is around a 5% capitalization rate. So And then we're talking about when an investor, when they buy in this kind of portfolio, they look at the total return on investment. As you can see, the monthly net cash flow on 25% down payment is a mere $184. You're thinking, oh, the cash flow is too low. Yeah, maybe, but that's only part of the equation. The key is based on my projection of 10% appreciation at the end of the first year, 10% multiplied by 399 at the end of the first year of ownership, your appreciation is already almost 40,000 right there, right? $40,000 of annual appreciation plus your annual net cash flow of 5,700 divided by your down payment of $106,000. Already, as you can see, this is the number you look at, the total return on investment, which is 45%. Based on this hypothetical projection, if you will, right? So you're getting really half of your money back, right, in terms of appreciation and a little bit of cash flow. But some investors who may not be that savvy, they're thinking, why should I buy this property with such a low cash flow? You can't not strictly look at cash flow, as a narrow way of thinking. You have to look at a big picture. So the pros and cons. So again, a little bit of cash flow is not decent. It's good enough, especially given that the rental increase has been double digit. In fact, we have seen the acceleration of rents occurring all over the country for many reasons. Who's to say this $2,300 in the next couple of years may not be maybe even higher than $2,300 rents, could be $2,400, $2,500. So, but the big picture is equity growth. You buy for equity play, just have a break even or slight positive cash flow. To me, is quite all right. So again, each investor is different. So with that in mind, Richard, what are your thoughts in terms of a non-numerical factors? What are the pros and cons based on your analysis on these property types?
Absolutely. And yeah, I mean, once again, different types of investments for different people. If you're like me in your mid-30s, a lot of working career ahead of you, good income coming in, and the cash flow is not as important. You're looking more for wealth building and asset diversification that has low maintenance and is going to attract a good quality tenant. Sometimes that makes maybe as much as you do. Then this is a great product. And the bulk of my portfolio are these newer construction properties with a little lower cap rate, but overall, obviously, they're in a good market, a good area. They're going to have low overhead, and you're going to start building wealth not only through obviously appreciation, but the fact that you're paying down the balance on this mortgage, or the tenant's paying it down every month as you make your mortgage payment. But I think they're great overall properties. And then also, as SeeWing said, if you get down to the cash flow, even if this thing double the cash flow it's making right now, right? Instead of 184, you're making 360. Or let's say it triples, right? So you're making $400 or $500 a month in cash flow. And most of the clients we work with make between $80,000 and $500,000 a year. What is that $400 a month cash flow going to do for you? And what do you plan on doing with it? Odds are a lot of our clients don't need that cash flow to live, and you may reinvest it back into the property to pay it down quicker, or you may let it accumulate into an account. But cash flow is very important, and if it's the most important thing to you, then SeeWing has properties in the Midwest that will fit that criteria. But if you are able to look a little more broad, and income at the moment is not necessarily the biggest factor for you, and you are looking to diversify some of your assets and buy a good quality asset that's going to be low maintenance, and that's going to perform over the long run, then these types of properties are the right types of properties for you. And I've determined that once again, most of my portfolio are the new construction properties in growth markets that may not have the most cash flow at the moment. But what we're starting to see as well is some of those properties I bought 3 to 4 years ago that were, similar very to this example, right? Minimal return, 3%, 4%. Well, guess what? Rent inflation is happening now, and the rents on those properties where I was making $200 profit have gone up, to by $200 and I'll make $400 profit, right? And that's where the wealth building comes into play. Even on a high growth, low cash flow property, that 2% return cash on cash, I think that was listed on that pro forma, that's not forever, right? Rents are going to go up. And as you make more payments, you're going to start paying down more and more of your principal, because every payment you make, a little more goes to principal, a little less goes to interest. So, I've seen a lot of those properties, not only have they gone up from, 250 to 350 in a couple of years, but now rents have gone up as well. And, I was reading an article in Barron's, which is an investment journal, the other day, and they were talking about rent inflation, and they went really deep into rent inflation and how it works, and how even though we've seen rent increases in the last year and a half, which a lot of you will attest to if you have properties, there's a lot more to come, and rent inflation or rents have not kept up with property values, and also haven't kept up with the general inflation we're experiencing in the economy, period. So, what I took, my takeaway from that article was in the next year or two, we are going to see rents go up even more. And a lot of these properties that you're buying for growth, let's say you're mid 40s, right? You have 20 years till you retire. Well, you're buying it now with low cash flow and growth. By the time you go to retire, 20 years later, trust me, rents are going to be higher. And at that point, it is going to be making cash flow for you over and above, and it's going to be close to paid off, So once again, different investments for different people. Know what your goals are. Make sure the property you're buying fits within those goals, and have realistic expectations of what you're buying, right? The experience, not saying it's bad one way or the other, but the experience is going to be different when you're buying a high cash flow property versus a growth property that's new construction in a nice area. And different of those products may be the ideal situation for different investors. It's not the same investment for every investor out there. And that's why SeeWing comes into play too, is it's not just like, hey, look at all these properties, go buy them. Let's talk about your goals, and then let's talk about the right property in the right market to fit those goals.
Yeah, exactly. Well said. Of course, I mean, often when my investors come to me, again, everybody's different. Some people have just enough money to buy one property. Some investors have money to buy 10 or more properties. So we like to use the benchmark of 10 property portfolio acquisition. So potentially, Richard and I, we recommend, buy 5 property in the Midwest for cash flow, and then 5 properties in the South and Southeast for higher appreciation. That way you can do, cash flow appreciation, asset allocation, diversification, region, market diversification. So, it's just it's a fun process, and we love advising people that way. We are, first and foremost, Richard and I, we are advisors to our investors' goal. We're not selling a property just for the sake of selling it. So anyway, thank you so much.